I have friends that do long commutes. I'm sure we all have friends and family that do half hour, hour plus. She works in Albany, New York, and that commute would be a little over 8 hours each way. So to make the justification that your home purchase in Norfolk, Virginia is your primary residence, obviously that can't be the case, right? Episode number 38. Welcome back. This is the Expected Returns Podcast. My name is Stephen Luttman. I am a real estate investor and agent here in the capital region of New York State. A lot of fun topics for us today. However, before we jump in, if you are interested in learning a bit more about the ongoing trade war between the U.S. and China, specifically how the U.S. Treasury market might be impacted, head on over to sjlincoln.com/join. That way you can sign up for our newsletter. The piece we put out earlier this week talks a little bit about how borrowing rates within the United States could be impacted between what's going on with the ongoing trade war between the U.S. and China. Again, sjlincoln.com/join. That's it for the intro. Let's get into the episode. We'll go ahead and kick things off today with discussing why it is always important to tell the truth, especially when you're dealing with banks. Now, this past week, the director of the FHFA made headlines when he gave a recommendation to the United States Justice Department to look into possible instances of mortgage fraud committed by the Attorney General of New York State. These are very serious accusations made against very important people. Who's involved here, and what are the ultimate consequences for someone found guilty of mortgage fraud? Letita James was elected the Attorney General for New York State in 2018. Really rose to prominence in 2019. If you remember the falsifying of business records case that was brought against President Trump, she played a major role in that. That did take place in New York State. Ultimately, President Trump was found guilty, and the judgment size was in the several hundreds of millions of dollars. That case is under appeal at this point, so we don't have a final verdict. However, fast forward to the election of 2024. President Trump gets reelected. I'm sure that was not the ideal outcome for Attorney General James, because here we are, 2025, and she is under the crosshairs of the United States Justice Department. 3 instances that were brought up that the director of the FHA wants the Justice Department to look into: having a father listed as a spouse on a mortgage application, claiming a 5-unit building as a 4-unit building, and listing a home purchase in Virginia as a primary residence. We'll start with the first one: why someone would claim a father as a spouse on a mortgage application. So it looks like this allegedly took place. There have been no charges at this point. We haven't seen any evidence. Obviously, no one has been found guilty of anything at this point. This is just the information that's out there at this time. Best I can surmise, this first happened in the mid-'80s. She would have been, I believe, in her mid-20s at that point. So why someone would claim a father as a spouse on a mortgage application? Best guess is that if she was looking to use some gift funds from a family member, there's caps in terms of how much a family member can give you for a home purchase, versus if someone is a spouse and a co-applicant, both of your incomes, both of your assets can be used. So I don't have an exact answer as to why someone would do something like this, but I believe it was because most likely at that point in time, she might not have qualified for the mortgage on herself. Having a spouse is going to be more impactful than a co-signer that's a parent or whatnot. So that would be my best guess, is that the assets under her name weren't sufficient, so that's why she brought in. So allegedly, she listed her father as her spouse on a mortgage application more than once. That's my best guess for why that would happen. This might relate a little bit more to my investor friends out there and investor clients. When we're dealing with financing of multifamily properties, the line of demarcation is from 4 units and 5 units. Anything that's up to 4 units, that falls under your residential financing. 5 and above suddenly turns into commercial. When you get into commercial financing, we're talking you no longer have access to 30-year debt. You no longer have low down payment options. Interest rates are going to be a little bit higher. Costs and origination fees are going to be a little steeper. So the allegation was that it was actually a 5-unit building that she, on her application, called a 4-unit. The rebuttal I've seen from her attorney is that it's actually under the assessment rules. It is actually a 4-unit, supposedly. It has been rented out as a 5-unit at some point. So it sounds like there's a little bit of gray area in terms of how the building is structured. However, that is a pretty serious change between whether it's a 4-unit or 5-unit. It is going to be much more favorable to be on your 1 to 4 side than your 5-unit plus. So that covers the possible why someone would do that this was a purchase about 10 to 15 years ago in Brooklyn. And most recently, there was a home purchase in Virginia that supposedly on the mortgage application, when asked, is this your primary residence, an investment property, or a second home? She listed it was her primary residence. Now, that's going to be a bummer because I have friends that do long commutes. I'm sure we all have friends and family that do half hour, hour plus. She works in Albany, New York, and that commute would be a little over 8 hours each way. So to make the justification that your home purchase in Norfolk, Virginia is your primary residence, obviously that can't be the case, right? And unfortunately, again, if you are the Attorney General for New York State, you do have a requirement where you do need to live in New York State for your position. So that can't be the case. Why banks care? When they ask you these questions, they aren't doing it just for kicks. There are reasons to why the banks ask these questions. If, for instance, you were to run into financial difficulties, let's say, and you had your primary residence, you had a vacation home, maybe you had an investment property. 9 out of 10 people, if they have to make a decision of which property am I going to pay for, are going to make the payments on their primary residence, the house that they actually live in. So when you mark down on your mortgage application, this property is going to be my primary residence, you then qualify for lower interest rates, lower down payment requirements, because the banks are more comfortable with the fact that, okay, if things should go poorly, this is going to be a very sound investment from the bank's perspective because this is where she lives. This is where the borrower lives. She's going to do whatever thing she can to make sure that she gets her payments in for this property. So that would be the incentive for someone to say, hey, this is my primary residence when maybe it's not. It's a little bit suspicious that someone as prominent as the Attorney General for New York State would make such a mistake. And it's not something that could have been done just on her end. I think if it turns out that this was actually, if there was something nefarious that happened here, yes, we want to have a conversation with Attorney General James. We also want to have conversations with her lender because this isn't something that a borrower could simply pull off by themselves. I mean, these aren't your everyday borrowers. I mean, these are very famous people, and someone that's the Attorney General for New York State telling you they're buying a house in Virginia as their primary residence, somewhere along the lines, there should be red flags going off. So again, these are all accusations, but I think if it does turn out to be true, there's multiple people that need to have, need to be reprimanded for possible malfeasance here. Next, an update on mysterious listings. But before we do, a quick word from today's show sponsor, Knollhaven Capital. Real estate investors, if you are in need of financing, debt service coverage ratio, short-term rental Airbnb products, portfolio loans, ground-up construction, large multifamily, Knollhaven.com is my mortgage brokerage. I'm a real estate investor. I know what real estate investors need in terms of financing requirements. Give me a shout, Stephen at Knollhaven.com. Knollhaven.com is the website. You can do a little bit of research in terms of what products we offer and how we can help. I am able to do business in most of the country. We are based here in upstate New York. However, that is not a requirement. We can help out almost regardless of where your project is located. But again, give me a shout. Happy to chat with you about, again, whether you're just getting started or you have a bunch of quotes and you're just looking to get a second opinion on something. Stephen at Knollhaven.com is my email address, and I'd be happy to talk with you about it. Knollhaven.com website, Stephen at Knollhaven.com. Now it's back to the show. Next, we'll pivot to a topic we actually touched on last episode. However, there have been some developments, so I thought it'd be worthwhile for us to revisit today. And that deals with pocket listings, also known as delayed listings, and how these ultimately impact the home sale ecosystem as a whole. There are real estate brokerages out there, Compass, Coldwell Banker, Century 21, just to name a few of them, that want the ability and have been fighting for the ability to keep listings more in-house. And the argument we discussed last episode was that there are home sellers out there that might not necessarily be comfortable or want mass exposure for the home sale. Could include getting found on your Zillows.com, your Redfins.com. In some instances, you can make the case home sellers don't want that. So the certain real estate brokerages are making the case, we want the ability for a certain period of time to keep that in-house, a little bit more quieter, and market the property that way. Now, under the Clear Cooperation Agreement for the National Association of Realtors, previously, that would have been a big no-no. Whereas when we take in a listing, when I'm about to market a property for sale, once I start marketing that property, I take the listing, I start marketing, I have 1 day to enter that property into the multiple listing service. The changes now are that the home sellers, if they so choose, can restrain the amount of exposure that the properties get. However, they need to sign a certain disclosure acknowledging they have been informed, they know the pros and the cons of doing so. However, they have elected to do this. So it's not something you necessarily opt out of. It's more of an opt-in. I don't want maximum exposure to my property. We talked last episode. I think this is a terrible idea if you are looking to sell your property. If you're an agent, good on you, because you're obviously trying to double side the deal, right? So it's a very difficult case to make for why this is good for home sellers. But if it is your home, and you are very comfortable with the fact that this is how I want my home sold. I want it in a specific manner. I want it directed at a certain group of people. Maybe we don't want to say group of people because then we run into fair housing, but I want it marketed in a certain manner. If you own the home, should you have that ability? I think you could easily make the case, yes, that if it's your property, if you own something and you want to sell it a certain way, maybe you should be able to do that. Now, who that hurts is kind of the home purchasers as a whole, the whole population, because if only, a quarter of the home buyer population actually gets to view it, is that really fair to the other, call it 75%? I don't know. That's a little bit messy. Who also thinks it's messy is Zillow, because Zillow has said, if you go about putting parameters in terms of what kind of exposure your property is going to get. So let's say you say, I don't want to be found on Zillow on the big platforms for a week or something like that. You are going to get blacklisted. They are not going to let you on at any point during your home listing. So why would Zillow take such a kind of a draconian stance on people wanting to do this? People coming to Zillow, eyeballs on Zillow is how Zillow gets paid. And if suddenly people start to view Zillow as, well, Zillow has some of the listings, but they don't have all of the listings, I need to go to other websites. That's not great for traffic for Zillow, for Redfin, for Realtor.com. So in an effort to kind of fight back against that, they're going to say, great, if that's the stance you want to take, where you're going to deny access or delay access from the property coming onto our platform, congratulations, you're never getting onto the platform. Best of luck in your future endeavors. So great on Zillow. I think it's fantastic, especially for kind of your mom and pop operations like myself, because if we run into a situation where the larger brokerages start keeping more and more business in-house, from a purely selfish standpoint, that's not great for me, right? Because sure, I could start keeping stuff in-house too, but my transaction volume is going to be a fraction of what your Compasses, your Century 21s, your Coldwell Bankers is going to be. So yeah, from a purely how do I keep my lights on standpoint, I think it's great what Zillow's doing. I think we want maximum eyeballs, as most sunlight on listings as possible. But also just from a consumer standpoint, when I go to buy a property, I want to be able to see everything. I don't want there to be secret shadow listings over here and I got to go onto each individual company's website to try to track these things down. I don't think that's healthy for anybody. So I'm glad Zillow's doing it. It's good for me. I think as a whole, I think it's good for the real estate industry. But in this one particular case, you won't hear me say this often, but I'm with Zillow. I think they're doing the Lord's work here. This is fantastic. So yeah, keep up the good fight. If you are a home seller and you are asked by your agent, hey, is this something, how do you want to market your property? What kind of exposure do you want? Unless you have a very good case for no, I think you really want to push for get this in front of as many people as humanly possible, whether it's Zillow's or the MLS or social media or newspapers or radio, whatever it is, you want as many people as possible seeing your house. So if for any reason your agent says, hey, I think I can do it better just by doing it a different direction, be very careful with that because, yeah, that's going to be in your agent's best interest. I don't know 100% if it's also going to be in your best interest as well. And finally, a few topics for us to hit rapid fire before we get out of here. If you are a home buyer in New York State and you fall into the category as being a first-time home buyer who is low to moderate income, the Homebuyer Dream Program just opened up. This is, again, grant funds designed specifically for folks that are first-time home buyers and are low to moderate income earners. When I first came across this program a number of years ago, I believe the grant program allotment was $10,000 maximum. Last year, they might have bumped it up to $20,000. I just opened up the website for the window for 2025. $38,000 is available maximum per household for the Homebuyer Dream Program. This is not open all the time. There's a certain window, and once the money is gone, it's gone. So if you are kind of on the sidelines, so I want to buy now, do I want to wait a few months? You may be waiting till next year. If there's no money allotted next year, you might be waiting for multiple years. But again, funds are limited. They are available right now. This is not something as simple as you fill out a form, you mail it in, and you get a check for $38,000. You do need to go through specific lenders that administer this program. So as a first-time home buyer, you're going to have a whole bunch of questions. Hopefully, you've interviewed multiple real estate agents. You found someone great. They should be able to steer you to how to make this program possible for you. And if for any reason you can't, or they won't do that for you, or they're not familiar with the Homebuyer Dream Program, shame on them. But if you do enough Google searches, you should be able to kind of figure out a little bit. If you can't, please reach out to me. Again, if this is specifically for New York State people, reach out to me. I can kind of steer you in the right direction, how to make it happen. But it's not forever. Make it happen now. If you are not in New York State, that doesn't mean you don't qualify for grant funds. There are grant programs throughout the entire country. I saw a news story this past week that in Washington State, they're discussing grants of upwards of $120,000 for minority home buyers. That is amazing. That is a lot of money. So we don't get $120,000 here in New York State, at least around here, but there are grant programs. Even if you don't live in Washington, again, there are grant programs for first-time home buyers everywhere. You just got to do a little bit of digging. But if you're in New York State, look into this Homebuyer Dream Program. Make sure the lender you're working with is familiar with it. Make sure your agent is familiar with it, and go out there and get that. Because if the government is offering us free money, if there's one thing we've talked about on this program before, it's that we need to go out and get that free money. Next up, what does the Capital Region housing market look like? Well, year over year, new listings are basically flat, no change. The days on market, this is a pretty good indicator of what the health of the ecosystem is. No change. It basically takes about a month to sell a property. So you put it on market. How long until you have an accepted offer? It's about a month. Now, this is going to be a lot higher than kind of where we were 2 to 3 years ago, but certainly a lot lower than historical norms and lower than most of the country, because we're hearing stories in Texas and Florida where inventory is starting to pile up. It's taking months and months to sell a property. What that means is if you're looking to purchase something in the capital region, do not expect that. You will need to act quickly because properties are moving. Median sales price is up, no surprise, year over year. Home prices just typically are appreciating in the capital region. That has been the case for multiple decades. It's a great place to own real estate. I wouldn't worry about massive downswings. At the same time, we don't have, 20% increases year over year outside of, the COVID year was an outlier, but, stable home prices is something that the capital region has to offer. The housing affordability index, this is going to be, basically what compared to what a median home earns contrast that to what the sale price is going to be. That's been in a pretty negative direction for a number of years. And finally, the inventory of homes for sale, very, very low. So if you are a home buyer, you are competing against not only people that are going to be aggressive with their bids, but also there's not a lot of houses to go after. So inventory is pretty low. That also means that months of supply is also going to be quite low. So that's kind of just where the capital region is currently, where it is going to be still pretty competitive, and you're not getting any banger of deals where home prices are still trending in an upward trajectory. Interest rates are an interesting story. We want to take a look going back to Liberation Day, which is going to be April 2nd, because that's when really not only the stock market had some pretty massive swings, but the bond market had some wild gyrations as well. So if we take a look here, okay, so that's April 2nd, and we are looking at the 10-year Treasury, which from April 2nd to today, and today is the end of April, we're basically flat. We're essentially almost to the penny. There has been no change. There's been a lot of ups and downs along the way, but if you go back to, again, Liberation Day, where things, that's when the tariffs were put into effect and things really kind of went off the rails, there has been no change. And if we look at what that means for mortgage rates, we are at, from a national average, 6.9% on 30-year fixed rate debt. This doesn't mean if you walk into your bank today, that's the rate you're going to get. It depends on how much you're putting down. Different banks offer different products. However, this is just kind of a national average to take a look at. And we can see that, again, we're pretty much, if we take a look at the purple line here, yeah, we're basically flat from where we were a few months ago. What is interesting is that for the longest time, the 10-year ARM actually had a higher interest rate than the 30-year. That doesn't make any sense. That's an outlier from historical norms. Why would that be? Well, in previous episodes, we've talked about the inverted yield curve, which is traditionally your shorter durations have lower interest rates, longer durations, higher interest rates to compensate you for locking up your money for longer periods of time. When the curve is inverted, just kind of flip it a little bit, where we've had shorter duration interest rates been higher than your longer dated. That's kind of flattened out since then. So the yield curve is it's less inverted than it was at this point last year. Something to keep in mind, that is an indication of a long periods of a inverted yield curve is a strong historical indication that there is a recession coming. I think we initially probably talked about that 6 or 9 months ago. And that's when we first started saying the recession's coming, the recession's coming. The recession hasn't come yet, but that doesn't mean we're not going to get it. It just means that maybe it's taken a little bit longer than historically. So the yield curve has reinverted. Historically, once that happens, that does typically mean the recession is coming. But what it also means is that 30-year fixed rate debt is now more expensive than the 10-year, which should be the case. That is going to do it for today. If you've made it to the end of the episode, first of all, thanks. But also, a few things you can do for me. Hit the subscribe button. When we first launched the channel, we had a whole bunch of subscribers, and it's kind of flattened out since then. I'd love to build the subscriber base a bit more. So if you could hit the subscribe button if you haven't already done so. If you can comment as well. If you have any questions specific to me, Stephen@knollhaven.com, KNOLLHAVEN. That is my email address. However, I'd prefer you put your questions in the comment section, because that way we can all learn together. And that's kind of originally what the purpose of this channel was to kind of build a platform where we can all kind of learn from each other's questions and answers and things like that. So subscribe, comment, and then ideally for episode 40, which is right around the corner, I'd love to make that kind of a listener question type episode. So get those questions in. That'd be great. Stephen@knollhaven.com if you want to chat about anything real estate, but specifically if you have financing related questions, I'd love to be able to help. If you happen to be in the capital region and are looking for home buying or selling services, Stephen@sjlincoln.com. That is my real estate brokerage, Stephen@sjlincoln.com. Thanks for watching, and we'll talk again soon.